Good morning, dear student. Myself, Dr. Eva Rani. In this video, I will be discussing about different techniques of capital busting. Capital busting is a process through which different project or investment can be evaluated. So here there are different types techniques can be used to analyze the risk and in capital busting. So there are majorly three different types are there: statistical technique, conventional technique and other technique. Under the statistical technique we have probability, standard deviation or coefficient of variation, while conventional techniques include risk adjusted discount rate approach or certainty equivalent approach. So RADR approach, conventional technique. In this video I will be discussing about in details about the risk adjusted discount rate approach. Other technique which includes sensitivity analysis and decision tree analysis. So here the first technique which I will be discussing in details with examples, it is the risk adjusted rate of return, or it is known as RADR approach, through which different investment or project are being evaluated. It is measured used in finance to evaluate different investment performance by taking into account its risk level, as it name itself showing risk adjusted rate of return. So RADR approach, this is known as. So here it helps investors or a company to assess whether the returns generated by these investment are sufficient, or it will give compensation for the risk taken by them. So there are two types of return which will be included under this approach. It will be risk-free rate of return and it will be risky return. It is risky return is also known as risk premium. Risk-free rate return is known as it is the minimum rate of return expected by an investment without any risk, with zero risk by the investors. So mostly when we are looking into the risk-free rate of return, government bonds and all will be considered, and their rate of interest will be considered as the risk-free return. When it comes to the risky return or risk premium, it represents the potential return on investment subject to the market fluctuation and uncertainties. These investments include various levels of risk and their actual returns, which can be higher or lower than the expected return. So RADR will be calculated as risk adjusted rate of return. RADR is equal to risk free rate of return plus risky return. So risk free of return, it will be same for all the project or for any investment, and risky return will be based on that particular project or particular investment, what will be the risky adjusted rate of return. So we will understand this RADR approach with these examples. For example, here they have given an investment project which cost rupees 50,000 initially, and it is expected to generate cash flows in years for 4 years. This is the question. So the first year the cash inflows will be 25,000, second year is 20,000, 20,000 and then 10,000. And they have given you the risk-free rate of return is 8% and risk premium is 2%, and calculate the NPV of this will be the risk-free rate of return and the risk premium they have given in this question. You need to calculate the NPV of the project, and the project cost they have given in this question is 50,000. I have worked out this problem. So here in this problems they have given you the risk-free rate of return is 8% and the risky return is 2%. So as per this approach, your RADR will be comes under the 8 plus 2, total 10% of. So risk adjusted discount rate of return is 8 plus 2, that is the 10%. And this cash inflows they have given in the questions, we have seen it. The first year the cash inflows is 25,000, the second year it is 20,000, third year is 20,000, fourth year is 10,000. And here in normal when we are calculating the NPV, we are calculating the only 8% or RADR approach, only we are looking into the risk-free rate of return. But in this, as it is RADR approach, we will be looking into the investment through RADR approach. So we will be calculating both risk-free rate of return plus risky return. So here the discount factor we will be taking that 12%. 12% is RADR is 10 total 12%. Now this is the formula for the discounting factor. It will be, if it is the 10%, it will be the formula for the discounting factor is 1 divided by 1 plus I to the power n. If it is I is 10, 1 divided by 1 plus 10 by 100. So if it will be as 1 divided by 1.1. So this will give you 0.909. Here it will be 0.826, 0.759 for second year, for third year. Every time we will keep on dividing with 1.1. So the first year, if we are looking into that, it is this 0.909 have come 1 divided by 1.1. So it will give you 0.901. For the second year, it will be 0.901 divided by once again 1.1. It will give you 0.826. It will be keep on going it. So first we will calculate this discounting factors, and this cash inflow should be multiplied by this discounting factor. So for the first year, cash inflows is 25,000, discounting factor here 10%, which have come 0.909. So 25,000 should be multiplied by 0.909, which will give 22,725. Second year, cash inflows are 20,000 and the discounting factor is 0.826. So 20,000 multiplied by 0.826, present value of cash inflows becomes 16,520. In the third year, the cash inflows again 20,000, but the discounting factor is 0.751 in the third year. So the present value of cash inflows will becomes 15,020 rupees. Fourth year, 10,000 cash inflows as per the, it is 10,000, discounting factor is 0.863. So 10,000 should be multiplied by 0.683, it is 6830. Now we will calculate the total present value of cash inflows by adding these all 22,725 plus 16,520 plus 15,020 plus 6830 will give you 61,095 rupees. This is the total present value of cash inflows after 4 years. This is the value. Now we need to calculate the net present value, means whatever outflow it happens, whatever the investment we have done. So in this project we have invested 50,000. So NPV is 61,095 minus 50,000. So the NPV we got it after investment, after calculating the risk factor also. Your NPV is 11095. So 11,000 we will be getting after investing in this project, after calculating both risk-free rate of return as well as the risky return. So NPV will be considered whenever the NPV is positive, we will be accepting the project. Whenever NPV is negative, it means that when you are investing in any that particular project where NPV is negative, we should reject those projects, because the company will get in loss if investing on those project or proposal. So in this, as NPV we got it 11,000 positive, so we should accept the project. This RADR approach will be also applicable to mutually exclusive project. Here we are considering only one project, but in some cases, some questions you will be having the two project cash inflows they have given you and different risky rate of return. That time you can we can compare which project we should go. Better the NPV, that project we need to calculate. The project having the highest NPV, that project should be accepted for the future, which will be beneficial for a company. So in this, the first, if it is a independent project, NPV should be positive. If it is mutually exclusive project, means two projects, when you are comparing two projects, the project having the highest NPV, those projects which should be considered for that. So I hope you understood the concept of risk adjusted discount rate approach and how to evaluate the different project on the basis of risk adjusted discount rate approach, or it is in short form it is known as RADR approach. I hope you clear with this concept. Thank you. Bye bye.